Above and Beyond is the title of the 2014 annual report of ST Engineering, and it certainly took effort from everybody in the company to deliver the results that they did, because as you'll read in the Chairman and Chief Executive statement starting page 11, it was a tough year. We see that in the statement, we see that in each of the divisions, we see that in the numbers. And then in the next couple of minutes, I'll take you through some of the finer details. What we read here from Kwai Chong-seng, the chairman, and Tan Peng Hock, the president and chief executive, is just where the problems lay. And they've spelt it out in very candid and honest details as to where the headwinds were. Specifically, in 2014, their results were impacted by the business environment in Europe, the weakness in their specialty vehicles business in China, as well as the poor performance of their shipbuilding operations in the United States. These three. So these are the three themes to keep in mind as we go through the rest of the annual report. Specifically, in Europe, they faced a weak economy. They didn't have the economic rebound that they were hoping for, and as a result, an air transport market which required them to restructure their aerospace operations in that part of the world. Under the subheading, taking the tough decisions, they spell out as to what they did, namely move some of their Oslo and Madrid-based operations to Singapore and maintain a toehold in Europe through their Stockholm and Copenhagen operations. And again, we'll come back to that when we talk about the aerospace division in a few minutes. Further along in the United States, their US Marine yards had cost overruns on two new build projects. Now, we'll again see this when we go through the numbers, but in essence it meant that revenue was up, but profitability was down. The reason was, as they highlight here, non-systemic design and supply chain support issues. So in theory, that means that these issues won't be repeated. They were not systemic. They weren't a problem with the process. It was these two projects specifically that had these overruns. And further highlighting along, in China, the slowing economy, now only around 7%, a multi-decade low, in particular in the infrastructure construction sector, impacted their construction equipment business. And in fact, it appears that they've sold their 50% stake to the other 50% shareholder in Beijing in order to get out of that business. And again, as they say in the annual report, take the tough decisions. You can read that in Chinese as well, starting on page 14 if you wish. But for now, let's take a look at the revenue figures and some of the numbers that provide, I guess, the financial evidence to the story that we've heard about so far, the problems in Europe, China, and the United States. What we see here is that group revenue was down 1% at $6.5 billion. And looking through those numbers, you can see that commercial customers still made up about 61%, the rest in defense. And what these other two graphics here indicate is where their customers are and where they're serving their customers from. And the main difference between these two charts is that a lot of their customers are still in the US, that's in yellow, and they still have customers in Europe, but they're actually servicing those customers from Asia. That's why that right side, blue part of the right graphic there is longer than in the middle graphic. So a lot of the customers in other parts of the world being serviced out of Asia. In this particular page here, page 58, 59, you see a number of graphics which again spell out where some of these problems were, where some of the revenue came from. In particular, take a look at the gray part of the bar on the far left. That top gray part there is the marine business, and it was the only one that grew in the 2014 financial year, up 8%. Overall, you can see that the curve kind of flattened. The three-year run of revenue growth ended in 2014. But thankfully, the marine business chipped in on the revenue front. Aerospace at the bottom there in blue, that was down 1%. Electronics in yellow, down 4%. And land systems in green, revenue there shrank 5%. So revenue declines in all divisions, that is, except marine. Now that's going to be important as we change the graphic and look at the profitability numbers. Profit before tax told a very different story. Marine might have grown 8% in terms of revenue, but in terms of pre-tax profit shrank by 16%. Again, those cost overruns that we talked about. The aerospace division was down 1% in terms of revenue, but down 11% in terms of pre-tax profit. So once again, the rationalizations of those operations in Europe certainly flowing through here to the bottom line, or the pre-tax bottom line. Land Systems, which you saw earlier shrank by a little bit, profitability, wow, down almost 50%. That green segment becoming really, really short in that leftmost bar. And Electronics, which, as I mentioned, saw a 1% decline in revenue, actually saw an 8% increase in terms of pre-tax profit. So helping to prop up that bar, showing the 2014 pre-tax profit numbers. So you can see, not necessarily just because they have higher revenue do they register higher profit, or just because there's a decline in revenue that there is also a decline in profit. You really need to take a look at these charts to see what the full story is in detail. On to the dividends, because they're obviously always important for shareholders. And this number here, 15 cents per share, really belies some of the things that are going on behind the scenes. And for that, we can turn to this chart here on page 61. What you can see here is that the revenue grew after 2010, grew to 2011, and in 2012 they had a dividend of more than 16 cents per share. But in 2013 they notched that back to 15 cents, and they were able to maintain that in 2014. But look at the blue part of this line, because what it shows you is that the ordinary dividend now is up to 8 cents per share from 7 cents in the previous 4 years. Now, there's no guarantee that they'll continue to pay dividends. They have to declare dividends every year, depending on how the operations are going, how the profit is looking, and so on. But the fact that they've notched up the ordinary dividend from 7 to 8 cents per share suggests, only suggests, that they may pay a higher dividend, ordinary dividend, into the future. And because usually companies only increase the ordinary dividend when they think that they can sustain that. So no guarantees, but the fact that the ordinary dividend, that blue part of the line, is longer suggests that they're more comfortable with their dividend payouts into the future. Now, let's take a look at the total shareholder return, though, because even though they maintained the dividend at 15 cents per share, unfortunately for shareholders, that kind of got wiped out by the declines in the share price. Total shareholder return down 10% after a fairly small gain the previous year, 7.6%. I say small only because the 2012 year was such a good year for them. A negative return in 2014, which shareholders would only be too acutely aware of. So what is the company doing? You can read more about what the outlook is and where they're investing and what initiatives they've taken to grow the business here on pages 12 and 13. In summary, what these 2 pages say is that they're going to build on their strengths, go where their customers are in order to make sure that the revenue keeps coming in, and move up the value chain, particularly as markets like Malaysia, for example, in the marine business, are very competitive on price. So moving up the value chain means that they're going to focus on their higher value and more premium, and therefore higher priced types of services. The order book, $12.5 billion. Again, the number on its own doesn't mean much without looking at the context. So let's look at page 59. And on this chart here, you can see how the order book has tracked. Certainly it's up substantially compared to where we were a few years ago, or as indicated by that line in the middle where the financial crisis was. It's not quite at the $13.5 billion, which was the number at the end of the 2013 financial year, but still at $12.5 billion, that's about twice the annual revenue that ST Engineering books. So still a very sizable order book. In terms of where their capital is allocated, this is also important for a company the size of ST Engineering. Their net asset value is around $450 billion. When you include the intangibles, it's around $600 million rather, so a very large company. And a lot of capital there tied up both in terms of the products that they need in order to service their customers. My favorite part is the blue part, which shows you what the cash holdings are. $1.4 billion once you strip out all the cash that's already been committed elsewhere. $1.4 billion, down from $1.9 billion the previous financial year. Read page 230 in greater detail if you want to know where their cash is. Overall, even though ST Engineering does have some debt, their net position is actually cash. In other words, they have more cash than debt. It was $850 million in the 2013 financial report. In this financial annual report, it is down to 686 million, but still, as you'll read on page 54, still a net cash position. On to page 55 and onwards, where we see the cash flow statement graphically represented. You can see in the bottom part of this chart here that the net cash from operations is less than last year, and net cash from financing, they spent much more on financing than they did last year, but still, as I mentioned, at least still cash flow positive where their operations are concerned. Let's turn over to page 65. This is the sustainability report. A couple of interesting things to highlight from here. Firstly, a lot of sustainability reports have a lot of photos of tree planting and other feel-good things like that. But in actual fact, in a sustainability report, you ought to be looking out for initiatives that are not just good for the environment, not just good for society or governance, the so-called ESG, but also good for business. And in that sense, when they break down, for example, how much they're spending on electricity or their water consumption, that's not just an environmental question, it's also a business question. So with that in mind, here is a graphic showing you the greenhouse gas emissions. And ST Engineering points out that it's taken part for the first time in the Carbon Disclosure Project, in which they won the Best Newly Disclosing Company Award for Hong Kong and Southeast Asia. So you can see that for yourself in the sustainability report, along with the water consumption. It appears that they're using a lot more water, looking at this graphic in particular. And the other thing you'll find in the sustainability report is some very specific numbers for directors' remuneration and their executives' remuneration. Frequently, companies just tell shareholders what these numbers are in bands, in ranges of around 250,000. Here, they actually spell them out on page 116 and 117 in great detail. You can look at it for yourself, read up all the numbers in the annual report ahead of the AGM.